Imagine you're sitting in a classroom, surrounded by your fellow students, eager to learn one of the most crucial concepts in trading: market structure. Today, we're going to dive deep into the world of market trends, and I'm excited to share this knowledge with you. Market structure, or the way a market is organized, is like a map that helps traders understand the direction of a market and where it's headed. It's based on one simple idea that markets tend to move in trends, and these trends are created by a series of higher highs and lower lows. Think of it like navigating a highway, where the road twists and turns. As a driver, you need to pay attention to the signs and signals to know which direction to go. Let's revisit the roller coaster analogy. Imagine you're riding the roller coaster with hills and dips. The highs are like the peaks of the hills, and the lows are like the bottom of the dips. As you ride the roller coaster, you notice that each peak is higher than the last one, and each dip is lower than the last one. That's basically what we mean by higher highs and lower lows. In trading, we use the terms higher high HH and lower low LL to describe what's happening. A higher high is when the market price touches a new high, creating a higher peak. A lower low is when the market price touches a new low, creating a lower dip. Let's take a stock example. Suppose we're trading a stock called Acme that's currently at 50. Yesterday, it was at 48, and the day before that, it was at 45. Using our roller coaster analogy, this would be represented as a series of dips, lower lows. The market is trending downward, and as a trader, you might consider selling the stock if you believe it's going to continue its downtrend. Now, let's say the market price of Acme goes up to 52 today, creating a new high. This would be a higher high, and it could indicate that the market is turning around and getting ready to move up. As a trader, you might consider buying the stock if you believe it's going to continue its upward trend. But here's the thing: trend changes can be tricky. When the market shifts from a downward trend to an upward trend, or vice versa, it's like waiting for the roller coaster to stop at the top of a hill before you know its direction. It's essential to focus on the big picture and not get caught up in short-term volatility. Common beginner mistakes occur when traders misidentify higher highs and lower lows, or assume that a trend is reversing too quickly. To avoid these mistakes, it's crucial to practice patience and focus on the long-term picture. Don't get caught up in emotions, and don't make impulsive decisions based on short-term market movements. Now, let's talk about some additional concepts that are essential to understanding market structure. One of these concepts is the idea of support and resistance. Support is the level at which a stock price stops falling, and resistance is the level at which a stock price stops rising. Think of it like a bungee cord that keeps the stock price from falling too low or rising too high. Another important concept is the idea of price action. Price action is the way the market prices move in response to news and events. A strong price action can signal a trend change, while a weak price action can indicate a lack of momentum. To practice identifying higher highs and lower lows, I want you to grab a demo chart or a paper trading journal and choose a stock that you're interested in trading. Look for patterns of higher highs and lower lows over the past few days, weeks, or months. Be honest with yourself and try to avoid getting caught up in emotions. Remember, the goal is to practice patience and focus on the long-term picture. Here's a homework exercise for you. Take the stock ABC Inc. and look at its chart for the past 6 months. Identify the higher highs and lower lows and describe what the market structure is telling you about the direction of the stock. Is it trending upward, downward, or sideways? Use this exercise to practice identifying market structure and predict future market movements. In conclusion, understanding market structure is a vital concept in trading that helps you identify trends and predict future market movements. Remember that markets can be unpredictable, and no one can guarantee profits. Trading involves risk, and it's essential to practice caution and follow a trading plan. As you continue your trading journey, keep in mind that market structure is not just about identifying higher highs and lower lows, but also about understanding the bigger picture. Stay focused, stay patient, and always keep learning. For your next lesson, we'll be exploring more chart reading techniques and strategies for profitable trading. Before we wrap up today's lesson, I want to remind you to follow us on social media for daily market